All I do is look at the history and say the best guess is that a bubble will behave like a bubble. And the more remarkable meta-level question is how come people can get away with saying nobody saw it coming? Each time, nobody saw it coming, when the data is screaming that you can't possibly miss it. You first semester course of statistics, you could not miss 1929. You could not miss 1972. You absolutely categorically could not miss 2000 when it went to 35 times earnings. The previous high PE had been 21. It went to 35 for heaven's sake. In Japan, it went to 65. No, you cannot miss these bubbles. And you could not miss the one in 2021. It went to a peak that rivaled 2000. And in some ways it was cheaper, some ways it was more expensive, but it was a very, very obvious bubble. Do not tell me that you can't see these things. And they all break, no exceptions. And if you say that, you'll be called a permabear. But history is quite clear. There are clear bubbles. They have always broken. This one is breaking. What is the average consequence? If you're lucky, 3,000. It always happened in every bubble, because you start with such euphoria and such perfection fundamentally that deterioration is a heartbreaker. If you really believe that good times would roll forever, then you're not only dealing with bad information, you're dealing with a heartbreak. You're disappointed. You have been let down by the system. And once again, the stresses are very high and something will break. Yes, I'm surprised it was Silicon Valley Bank, but I am not surprised that there was something surprising like Silicon Valley Bank. I would have been surprised if nothing had cracked, and maybe next month, maybe early next year. But when you keep up a pressure, we have more debt now than we have ever had. We probably have more debt than we realize. It is well argued by some people. And consequently, when you put the interest rates up, you have, in the banking system, $600 billion of unrealized losses. But in the system writ large, you have a lot of pain already, quite a few $1 trillion, and quite a few trillion more likely to come. And everything has consequences. When you write down perceived value by many trillions of dollars, and it will be more than 10 by the end for sure, collectively, and you've got multiple asset classes contributing, they all have consequences. And you should not be surprised if a chunk of the credit system comes under stress. And maybe you shouldn't be surprised if we get lucky this time and muddle through. But these are the kind of things that have happened in each of the prior cycles. And as a general principle, the bigger and broader the bubble, the longer and more painful the downside. Japan, the biggest of all, is not back to the high of 1989 in the stock market. It's not back to the high in land or real estate. That's getting to be quite a long time. That's 34 years and counting, and it still hasn't reached the old high in nominal terms. So, the biggest lag getting back to a high ever, and the biggest pain. But it was the biggest bubble. It's perfectly symmetrical. And this one is pretty damn big. And it's bigger than 2000 because it includes real estate and bonds. And that one did not. So go and have a look at what happened in 2000 and the pain. And why was there so much pain? All of the things that they're hoping would happen this time happened that time. It was pretty painless. The economy had a gentle recession. It had no problem with real estate. It had no problem with markdown of debt. And yet the NASDAQ went down 82%, not an insignificant decline. Amazon actually went down 92, and the S&P went down 50. So be advised, this is not a genteel setback like 2000. NASDAQ went down 40% in 2000. Whoopee, it's all over. That was quick. That wasn't too bad. I survived it barely, but I survived it. The point is, 2001 was down 20%. 2002 was down 30. So you had minus 40, minus 20, minus 30. That's how you get to minus 82. It was pretty painful. But everyone thought it was over after the first 40% decline. I have to brag here a little bit that on the day the market hit the low in 2009, I posted one of only 2 papers I've ever written outside of a quarterly cycle. Now I've quit that. I do special papers, but in those days, only quarterly letters. And I posted one called Reinvesting When Terrified. And it was only 1 page for once. And it said, you are not going to call the bottom, but get together a battle plan. This is the cheapest prices for 20 years. We have double-digit imputed returns on GMO's forecast for the next 7 years. Go to your committee, get the battle plan together, and start getting your money back in the market. Of course you're terrified. Of course you're practically in terminal paralysis, we used to call it in the 70s. But that's what you have to deal with. So I have not always been bearish. And there will come a time probably when we reach another level. But that was a very, very handsome opportunity to buy stocks. Economic unraveling can take a long time. And why? Just think about housing. Housing is one of the most dependable things that happen as a result of interest rate. If you had a mortgage at 2.8 and then a new mortgage is 5 or 5.5 or 6 or 6.5 for a while, this is a dramatic shift. It changes the housing markets all over the world. Turns out that the housing market is more elevated. Unlike the stock market is mainly a US event like it was in 2000. Housing market is, yes, it's in the US. We actually were selling in December at a higher multiple of family income, which is the best long-term measure. We were selling slightly higher than the peak of the quote housing bubble of 2006. But we were still in December way below Canada, Australia, the UK, China. They are having real humdingers. They are not going from 3.5 times family income to 7 times. They have gone to double-digit multiples of family income in most of the districts of London and Toronto and Vancouver and Sydney and so on. And they are floating rate. So the cost flows immediately through and has a crippling effect. But it doesn't work overnight. It has a slow effect on building new houses, which is not that big a component of GDP, but if you throw in furniture sales and improvements and so on, it's quite a bit. That goes down steadily. The housing declines typically go at half or a third of the speed of the stock market. Stock market is always kind of on speed in comparison. And you can't count, the last housing bubble peaked in 2006 and troughed in 2012. It took 6 years. And the stock market that time took 1.5 years. But sometimes it takes up to 3 years of a bear market in stocks. But housing can be much slower. So it slows the economic effect way down. It filters through very slowly. Some of the initial impacts are counterintuitive. People don't want to sell because they can't afford to pay a new mortgage. So they're very reluctant, quite reasonably, to give up their 3.25 mortgage and replace it at twice the cost. So the housing supply counterintuitively drops off and can create artificially reasonably high prices for a while. And that gradually flows through the system. However, people get normalized. They have to move eventually, and so they do, and the prices weaken. But the economy moves very slowly. And then you look around in general to see where the stress points are. I was in a podcast 2 days before the crash, and I was making the same point that the stresses build up like a huge pressure behind a dam, and you can't really work out which brick is going to go in the dam first. You can be pretty confident that sooner or later, the great bubbles, as they break, will find a pressure point. And you can also be pretty confident that you will probably be surprised exactly where it occurs. So we have just recently seen some unexpected pressure points, which you could say are unexpected, but I would say from 60,000 feet, they're totally predictable. It is predictable that something will fail and you will be surprised at what particular piece it is. I have been saying this for years and I feel totally vindicated that something has gone and something that went is unexpected. That is the nature of the beast. The trouble with this bubble is the troubles are actually manifold. One of which is, as many people have said, it's an everything bubble. So we have bubbled the important and dangerous housing market. Not as crazily as we did in the housing bubble, but in sheer price, we boosted it up to records. We bubbled the bond market to levels that had never been seen in the history of man, with the lowest rates ever recorded, of course. Fine arts and every other asset through the roof, and equities, particularly in the US, at or close to the highest points ever reached in the most dependable forms of a long-term evaluation, where you smooth the earnings Schiller style, or one could say Hussman style. The most reliable ones are at or close to the level of 2000.